With the word recession creeping back into the headlines, in this week's video, we're going to discuss if this is just a scare tactic or if these are real concerns.
Last week, all four of the major U.S. indexes were positive, with the S&P 500 and the Dow Jones both up about 0.5%, while the NASDAQ was up almost 0.75%, and the Russell 2000 was up 0.55. And still, the NASDAQ is the leader for the year, up over 18%. Foreign markets were down about 0.25% last week, while emerging markets were up almost 1%. And now, emerging markets are up over 6% for the year, while foreign markets are still up double digits, up over 11% year to date. Today, we wanted to look at a chart of lumber. And the reason we want to look at lumber is because this can be a possible gauge of the health of the U.S. economy, as well as signal possible recessionary behavior depending on where the price of lumber falls. The price of lumber has fallen sharply since February of this year, showing signs of a possible looming recession. But last week, we saw lumber hold on to a very important level here, and that's a blue line on the chart, right around 300, as lumber bounced sharply higher. Now, this is very short term, but this is showing increased building in the U.S. economy, and that's also a positive sign for the U.S. economy, as those recessionary fears seem to go to the wayside a little bit. Now, what we're watching for is that blue line, again, at around 300 on lumber. And if that blue line gets broken down below 300, this could be very concerning for the U.S. economy and could bring those fears of a recession back to light.
The first big news story from last week was the Morgan Stanley Business Conditions Index. Now, this is a proprietary index to Morgan Stanley, and it tries to gauge the current economic conditions inside of the United States. This index takes into account manufacturing, employment, the prices of goods, and trade data. Now, this index just had its biggest one-month drop ever, and we're back to levels that we haven't seen since 2008 and 2009. Now, although in our opinion, we don't consider that the current economic conditions for the United States, but it is worth noting that this is the second Morgan Stanley index that has flashed a very large slowdown ahead. Now for some positive news for the U.S. economy. Retail sales numbers for the month of May came out last week, and after a dismal first quarter, retail sales have rebounded sharply, showing an increase year over year of 3.5%, which is normal consumer spending for the United States. So this is a good sign that consumers are back spending and the economy is moving in the right direction. The last thing that we wanted to look at was the Fed funds rate and the history since 2000. Now, the Fed funds rate is the rate that the Federal Reserve sets for banks to loan money overnight to each other. And it trickles down to the U.S. consumer through whatever interest rates the banks are paying out both on deposits and charging in regards to loans. Now, back in 2000, the Fed funds rate was sitting right around 5.8%, and it climbed up to 6.5%, and then dropped drastically after the recession hit when the tech bubble burst, and sat around 1% for years. Once the economy started to improve, the Federal Reserve got interest rates back up over 5%. Now, interest rates dropped down to 0% after the financial crisis, and they stayed there for years. Now, only recently did the Federal Reserve start increasing interest rates, and we're currently sitting right around 2% for the Fed funds level. If all of the economic concerns come to fruition, the Federal Reserve doesn't have a whole lot of ammo left to drop interest rates, as they can go from 2% to 0. And the possibility of a negative interest rate hasn't come to this country yet, but we've seen that happen around the world. And if we're looking closer at this chart, you'll see that interest rates have started to levelize, and the next move could be lower. This week, all eyes are going to be on the Federal Reserve as their two-day meeting wraps up on the 19th. Now, there's not supposed to be an interest rate decision from this meeting, but rumors are that the Federal Reserve is going to change language from being patient with the economy to the possibility of future rate cuts.
So it'll definitely be interesting to see how the markets react to this news. Will they be excited about the potential of a rate cut in the future, or scared off because of the possibility of the economic slowdown continuing?
Thanks for watching, and if you're on YouTube, please like and subscribe to our channel. And if you're watching on Facebook, please like and share our video.